Welcome to the AJ Bell Managed Portfolio Service Review for the second quarter of 2020. And it's my pleasure to be talking you through the quarterly review covering our investment solutions, ranging from passive, active and Pactive, which is a hybrid portfolio of passive and active investments. This webinar is likely to last for around 20 minutes. In this webinar, we'll introduce AJ Bell Investments, review the second quarter performance of the portfolios and markets, talk through the major fund contributors and detractors, and update you with any recent changes, and then conclude with our market outlook at the end. Now, AJ Bell Investments was launched in 2016 in order to build and manage investment solutions, which was a natural extension to the platform business. In the last 4 years, we have built up a strong product range for you to consider, and we hope that this caters for most of your investment requirements. As you will see listed here, we offer passive and active solutions in both growth and income form, along with our Pactive range, which is a set of growth portfolios using both active and passive solutions. We then also have similar versions in a unitized format of AJ Bell funds, and our latest addition to the suite, the retirement portfolio solution, which is operated with a bucketing and natural income approach in order to help with the challenges of clients in retirement. We're very proud of our since inception performance of all our products, and the passive portfolios now have a 3-year track record for you to consider. The next 3 slides really detail the performance of our portfolios across the different ranges over different time periods. For the quarterly period, the passive, active and active portfolios broadly delivered similar levels of performance across their respective risk profiles. All 3 slides show a similar short-term story, which is that of a very strong bounce back from capital markets over the last 3 months. While the falls in capital markets was one of the shortest and sharpest a bear market has ever seen, this is also true for the recovery we have recently witnessed so far. Although it's clear to see that over the last 6 months time period, not all the ground has been fully made up over this very volatile and uncertain period. Worst hit was the Income 2 portfolios, which has not recovered as strongly as the growth portfolios. Income 2 is predominantly exposed to equities. Equity income in general is usually thought of as a very defensive area. However, as demand for company products fell to zero overnight, a situation not normally experienced even in the most harshest of recessionary environments, has meant that dividends have been severely under pressure in a whole host of sectors. Moving on to slide 7, and we'll now talk a little bit about market performance over the last quarter. There was a positive shift in investor sentiment during the second quarter, leading to an increase in risk appetite and a complete reversal of the previous quarter as COVID-19 lockdowns were eased and global economies slowly and partially reopened up. The unprecedented support from central banks and governments has been well received by the markets. Now, the performance in the slide is quoted in sterling terms. One of the top performing markets was the US. After a large jump in unemployment numbers at the end of the first quarter, the employment situation marginally improved through the recent quarter. Also helped by a very strong technology industry, which has seen much increased demand due to the new working environment. Other equity regions were also strongly up, but just to a lesser degree. Now, over in fixed income markets, these also produced good results as yield compressed further, translating into positive returns through the quarter. The riskiest areas such as high yield and emerging market debt produced the best returns. In another area, UK physical property, this was one area that continued to suffer, as shops and offices were shut for most of the quarter, leading to a very uncertain backdrop for the property market. Whilst the markets have experienced a strong bounce back it is still unknown as to what shape the economic recovery will form. Global PMIs for manufacturing increased from a low base, but even if a V-shaped recovery did indeed materialise, it could still take many years to make up for the lost out. Central banks around the globe have remained very accommodative, with low interest rates and large amounts of bond purchases in an attempt to keep economies afloat. UK equities, which is largely seen as a global market, lagged other major markets as some of the largest sectors in the index continue to struggle. One such example being financials, which have not been rewarded as much as other sectors given where interest rates have headed, which directly attacks their profit margins. On slide 9, we can see here the UK 10-year gilt moved from a 35 basis point yield to a 17 basis point yield through the quarter, as demand continues to outpace supply given the large quantities of gilt purchases from the Bank of England. We at AJ Bell remain cautious in this area, as in our view, the downside risks are very unfavourable, especially as gilts in general are longer duration than historically, and as such, we feel that their associated risks have now increased further. Determining the shape of the economic recovery still remains way too early to say with any degree of confidence at all, with many alphabetical letters branded around, such as V or U, to explain the shape of the economic recovery. However, hopes were underpinned by the recently reported recovery in UK retail sales of around 12%. Although it should be noted, retail sales only account for around a third of consumer spending in all. And it might be that some of that consumer spending has been saved from lockdown, such as gym memberships or dining in restaurants, was simply just spent online instead. As shown on the previous slides, the portfolios performed very strongly indeed over the recent quarter, with the riskiest portfolios, those with the largest allocations to equities, performing with the highest absolute returns. It's very encouraging to see such strong markets following such a weak period of returns, but given the market backdrop and the risks of whether a second wave will materialise, we would highlight that in the short term, we could experience heightened volatility going forward. But it's also important to recognise that investing should be for the long term, and therefore it is important to remain calm even in the eye of the storm. With that in mind, when markets fell suddenly, we definitely didn't panic, and we reminded ourselves of our key pillars, which enables us to focus on being truly long-term investors. The best periods of performance can happen in days and weeks, not months or years, and so it's incredibly important to remain invested and try not to time the markets. The asset allocation of the growth portfolios remained unchanged in the second quarter, allowing them to fully benefit from the market recovery. Our strategic asset allocation is built up with 3 dedicated sector exposures alongside our regional equity exposures. These included technology, healthcare, and consumer staples. The idea behind these exposures are that they are relatively uncorrelated to each other and therefore are additive to long-term risk-adjusted total returns. During the quarter, the technology sector produced stellar returns once again, which bolstered quarterly returns for the portfolios. On slide 12, we'd like to talk about some of the contributors and detractors for the Pactive MPS. And as ever, over a quarterly reporting period, the active portfolios will always have a number of strongly performing funds and some weaker ones, as the portfolios are built with balance and diversification from an investment style and market cap focus point of view. Now, the Polar Capital Global Technology Fund benefited from its sector being very much in favour, and exposures to stocks such as Spotify and PayPal, which were up around 80% and 30% respectively during the quarter, bolstered returns. Turning our attention to Asia, both Invesco Asian and Schroder Asia Alpha Plus benefited from their Chinese equity exposure, where the easing of lockdowns and returning to some kind of normality started first. Another area that's helped is the avoidance of the UK physical property funds, which has been a tactical asset allocation from day one of the active portfolios. Now, this was formed on the back of our concerns of unfavourable risk-reward dynamics in that sector. And secondary to this is the liquidity concerns. So instead, we favoured exposure to absolute return. Now, given the weak market backdrop for property and the fact that these funds have remained suspended firmly in place during the recent quarter, avoiding this area has certainly helped returns. Now onto the right of the column, the detractors. It really is a reverse of what was experienced last quarter given the market backdrop. Therefore, the funds that are more naturally risk adverse tended to lag a sharp market rise. Now this is very much expected. Storage Trojan Income is a really good example of this given its capital preservation mindset. A fund that protected from the relative sense last quarter didn't participate in the recent rally, and the fund is held within our UK equity blend for this exact reason, as it diversifies the blend and blends very well with another significant holding of Man GLG undervalued assets. JPM Morgan US Equity Income underperformed mainly due to its overweight in financials and underweight to technology. More broadly, stock selection against the wider benchmark was weak too, but this is because stocks with any association to income experienced a significant headwind given the extreme pressure on dividends. 24 corporate bond was also a bit cautiously positioned to fully participate in the rebound, as its credit risk is of higher quality than that of its benchmark. The income portfolios also rebounded well, but not quite to the same degree as the growth portfolios. Income as an investment style lagged the broader rally as dividend cuts started to be announced as the impact of the lockdown became a reality. Some of the growth areas that helped the growth portfolios hindered the income portfolios, as these areas led the market, such as technology, which outperformed the wider market by 10% through the quarter. Over in fixed income, high yield and emerging market debt, which are seen as the riskiest areas of fixed income, also recovered well, and the allocations to those areas in income portfolio 1 proved useful. European high yield market led the market for high yield and spurred the recovery. And emerging market debt in both hard currency and local currency terms produced around 10% of returns. Now, in our growth portfolios, we've made no changes to our asset allocation during the quarters. We remained comfortable with the exposures and changes we made at the annual strategic asset allocation review last quarter. However, the passive growth portfolios had a couple of ETF changes that I'd now like to talk through. After engaging with several ETF providers, we were pleased that Investco wanted to launch a new sterling corporate bond ETF at a much lower cost than what is currently available. So the portfolio is sold out of the Spider Bloomberg Barclays Sterling Corporate Bond ETF and switched into the Investco GBP Corporate Bond ETF, which is half the cost and tracks a more efficient index too. This affects the passive portfolios 1 to 4. The second change came in the form of switching from iShares Global High Yield Corporate Bond ETF into the JPM Morgan Global High Yield Corporate Bond Multi-Factor UCITS ETF. This change also lowers the cost of the overall portfolios and affects the passive portfolios 1 to 5. Now, we made the same ETF changes from our growth portfolios, which are also reflected in the income portfolios. In active income portfolio 2, we enacted a fund selection change by selling out of Artemis Global Income completely and switching this into the already held even load global income, taking that from a 5% weight to a 10% allocation. With the pressure on dividends, we wanted to focus the portfolio into the fund, which has a higher quality income bias. We hold high conviction even load for that particular style of investing. The other change, which is of significance, is an asset allocation decision and was implemented in the active and passive income 2 portfolios. With an increasing pressure on dividends, we opted to reduce UK equities in favour of high yield. Even with the likelihood of rising default rates in the high yield asset class, the income should provide enough of a cushion here. Moving on to the market outlook. As the world eases out of the lockdown phase and the recovery phase begins, it's too early to tell exactly how long it takes for economies to be firing on all cylinders again. In the meantime, central banks and governments are taking actions to stabilise economies and the world, and this has impacted positively on capital markets. But one of the largest threats remains with income investing, which is where we took some decisive action, as previously discussed in this webinar. Please do visit our website for update fact sheets, commentaries, and quarterly reports. We hope you found this quarterly webinar useful. And that really concludes the main presentation. But in the meantime, we at AJ Bell hope that you and your families all stay safe and healthy, and look forward to speaking with you in 3 months' time. Thank you and goodbye.